Hey, everyone. Welcome back to Stock by Vest channel. On May 16, 2025, Moody's Investors Service downgraded the U.S. credit rating from the coveted AA to A1, marking the first time in 37 years that the U.S. has been downgraded twice by two different agencies. In 2011, S&P downgraded the U.S. and in 2023, Fitch followed suit. So what does this mean for the stock market? Moody's cited rising U.S. debt and ongoing congressional debates over raising the debt ceiling as reasons for the downgrade. Moody's expects federal debt to reach 134% of GDP by 2035, up from 119% in 2024, driven by higher deficits and interest costs. As of May 2024, the U.S. national debt stands at approximately $33.7 trillion. In response to the news, markets took a tumble with S&P 500 ETFs dropping about 1%, and Nasdaq ETFs fell 1.3% in after-hours trading. Meanwhile, Treasury yields rose to around 4.48%. Higher yields mean increased borrowing costs, which could impact sectors like tech and real estate. However, it's worth noting that past downgrades haven't always resulted in prolonged market downturns. For instance, after S&P downgraded the U.S. in 2011, the stock market recovered within a few months. Moody's also gave the U.S. a stable outlook, suggesting that the negative impact might be temporary. They acknowledged that the U.S. still has strengths such as high income levels, a deep and liquid financial system, and a wealthy and innovative economy. So how should investors react to this news? Well, here are a few things to consider. First, monitor Treasury yields. If yields continue to rise, it could be a sign of increased borrowing costs and potential headwinds for certain sectors. Second, stay informed about market news and economic data. Upcoming earnings reports and economic indicators can provide insights into the health of the economy and corporate profits, which can help support stock prices. Third, consider adding defensive sectors to your portfolio. During uncertain times, sectors like utilities tend to be more resilient. And fourth, keep a long-term perspective. While short-term volatility is possible, it's important to remember that the stock market has historically recovered from various economic challenges. As we navigate these economic waters, it's clear that the road ahead requires vigilance and adaptability. By staying informed and adjusting our strategies as needed, we can better position ourselves to weather any upcoming storms. So what do you think of the Moody's downgrade? Will it impact your investment strategy? Share your thoughts in the comments below. Stay tuned for more insightful content. Thanks for watching, and we'll see you in the next one.